What we have seen historically is that once you start to see the Fed in this rate cutting cycle, REITs tend to outperform kind of core private real estate. And that's kind of twofold, right? One piece of it is that REITs are going to price in the impact of what's happening from a rate environment much faster than what you see on the private real estate side. And you tend to see these public markets get a bit more excited and price this in earlier.
Hello and welcome to the REIT Report. I'm your host, Sarah Borchersen-Keto. In this week's episode, we'll be looking at the macro environment and how interest rate moves are likely to impact the REIT and commercial real estate space. My guest to unpack that today is Uma Moriarity, Senior Investment Strategist at Public and Private Real Estate Manager, CenterSquare Investment Management. Uma, welcome back to the podcast.
Thanks for having me, Sarah. It's great to be back.
So, Uma, let's jump right into things. How did this week's Federal Reserve meeting outcome align with what you and the markets were anticipating? And what messages are they sending in terms of additional rate cuts down the line?
I think what happened at the meeting yesterday, the commentary that we heard is very in line with expectations. We saw that 25 basis point cut that I think was pretty widely broadcast during the conversations that have happened with the federal FOMC members over the last month or so, starting with the meeting at Jackson Hole, and really focused on kind of that risk mitigation around what's happening from the labor market perspective, how they're trying to manage that. I think we've seen a shift in terms of their focus on the labor market compared to what's happening on the inflation side. The Fed's preferred inflation metric, which is that PCE index from a core perspective, has been trending kind of the wrong way since April. But some of the revisions that we saw, for example, the big annual benchmark revision that we saw from the labor market perspective, as well as the weakness that we have seen in the monthly labor reports we've been getting over the last few months, I think has shifted their attention more towards that full employment part of their dual mandate. So I think a lot of that really in line with what the market was expecting. We did see one dissent in terms of that 50 basis point rate cut. That being said, it seems like we should be expecting another kind of measured 25 basis point rate cut in the upcoming two meetings. So I think the expectation more broadly is to see another 50 points of rate cuts from the Fed through the end of this year.
And how have REITs typically reacted to interest rate moves in the past? And what could the Fed's decision mean for REIT fundamentals and performance for the rest of this year and into 2026?
We did some research around this, and especially looking at how REITs perform compared to how the private real estate market performs, given we are, as you mentioned, an investor across both the public and private markets here from a real estate perspective. What we have seen historically is that once you start to see the Fed in this rate cutting cycle, REITs tend to outperform kind of core private real estate. And that's twofold, right? One piece of it is that REITs are going to price in the impact of what's happening from a rate environment much faster than what you see on the private real estate side. And you tend to see these public markets get a bit more excited and price this in earlier. So even when we started looking at rate cuts, the beginning of the rate cutting cycle last year, when the Fed first cut rates around the same time last year, you saw the REITs perform really well. And not only here in the US, but I think globally, you are starting to see this kind of easing from a monetary perspective. And so you've been seeing the global REIT market react to what's happening from this interest rate perspective. And as we're thinking about things, a few pieces here, both from a valuation perspective, but then also really understanding what the impact is across balance sheets for the REITs, what that means for borrowing rates, how that's going to be impacting earnings. We're really unpacking all of that and making sure that we're assessing all of that in the REIT market going forward.
And what do you see in terms of investors looking to deploy capital in the real estate markets today? Would you say there's pent-up demand, or is there more caution in the sentiment?
Yeah, that's a great question. I think a lot of the broader institutional investor base, which is really who we work with here at CenterSquare, they had been waiting for this kind of easing monetary policy environment as it relates to deploying assets into real estate. There were a couple of things that have impacted the allocations into real estate as an asset class for several years. We think about what happened first with kind of the denominator effect a few years ago, where you saw real estate allocations outsized compared to where targets were, because you were seeing equity markets pulling back, private real estate markets not being priced down as quickly. And so you saw a lot of institutional investors that were over allocated to real estate, and so didn't really have additional capital to deploy. And then from there, you saw a lot of kind of long waiting queues, especially in open-end funds, where investors were trying to take redemptions out of the private market, redeploy that capital into the listed market where valuations were a lot more attractive. And you saw a few gates going up And so you saw I would say some barriers in terms of being able to redeploy capital into the real estate space. But now we're definitely seeing a lot more demand because I think from just the allocation perspective, real estate allocations have been right sized back to the target levels because you have seen such a big run up in equities and other parts of the market, as well as the fact that you have seen some kind of pullback in terms of valuations and appraisals within private real estate portfolios to some extent as well. And so there is a bit more capital to deploy across the real estate space. That being said, a lot of the activity that we're seeing from our clients has been twofold. One piece in the listed real estate space, a lot of interest starting to pick up in global REITs. So that's been really great to see as investors are trying to deploy capital to capture the real estate asset class, but do it much quicker from a liquidity perspective. And then also get access to currently valuations that are much cheaper in the REIT market compared to what you see in the private market still. And then also get access to some of the more niche property types that you find in global REITs that you don't necessarily find in the private market. So areas like data centers, self-storage, healthcare, big parts of the REIT market, not really the same across the private side. And the other piece on the private side, we're seeing a lot of demand. We're seeing that across kind of niche areas of property types. And so in industrial, for example, we invest here in a product called service industrial, a very niche part of the overall industrial market. You're looking at small overall asset sizes, very small suites within that for our tenants, where you have tenants that are the local operators of, think about your HVAC repair guy, a CrossFit gym, those types of occupiers in very small industrial spaces that are located in infill submarkets. You're just not seeing supply of that sort of product today. Most of that product gets actually demolished and converted into higher and better use. So very different story within that part of industrial compared to overall industrial, where you are seeing oversupply impacting fundamentals. Those are the types of areas where we're seeing a lot of interest from institutional capital, where one, on the public side, you can get access to the liquidity, better valuations, niche property types. And then on the private side as well, looking at kind of those niche areas where you do have a much better supply demand dynamic happening on the ground.
Can you touch a little bit more about REIT valuations and how they compare to private real estate and where you see that trend going?
Yeah, absolutely. This is something that we track pretty closely here at CenterSquare. One of the things that we've noticed within the private real estate market, the appraisals, especially across kind of core Odyssey funds, let's call it, right? So I'm thinking about the Odyssey Index, how the appraisals are coming through for some of those assets. I mean, you have apartments. These are the latest data that we have on that front is really as of the second quarter this year, where apartments, for example, are being priced at a 4.3 cap rate. On the other hand, you are buying apartments in the REIT market for a 5.9 cap rate, right? And so there's still such a big difference in valuation in terms of where appraisals are coming through for some of the core property types across these core funds compared to where you can buy effectively the same types of properties, typically higher quality properties with a really strong management team in the REIT market. And so we still see a pretty big valuation disconnect between the public and private markets here, where I guess if you think about the 10-year yield, right, we started the conversation talking about what the Fed is doing on the short end of the yield curve, but the long end of the yield curve is still being priced by market forces. So if we think about where the 10-year treasury yield is, and I break that down into the most basic components of real growth, inflation, and what's happening from a term premium, you really can't get to below a 4% rate on that 10-year treasury yield, barring some sort of a recession. And so we think the long end of the yield curve remains a little bit elevated. So you're going to see a steepening of that yield curve. And that long end of the yield curve is what we're thinking about in terms of pricing real estate, right? And so as we think about where that 10-year treasury yield is, maybe a little bit north of 4%, pricing real estate versus that 10-year treasury yield makes much more sense in the REIT market, where you do have cap rates that make sense in the context of the higher interest rate environment that we're in today. Compare that to where you're seeing assets being appraised in the private market. Still, I think a little bit more room to go there in terms of being able to see that spread versus risk-free rates. So what are investors getting for investing in real estate compared to what they can get for just investing in treasuries? I think you still need to see a bit more of that spread expansion on the private market side, whereas I think the REITs have really priced that in already.
And what would you say are some of CenterSquare's high conviction REIT property types at this time? And what is your strategy for building resilient, growth-oriented portfolios?
So currently we're focused on a few different things. We're focused on really capturing secular trends versus looking at cyclical businesses. So when I talk about that, think about things like the aging population that is going into a needs-based demand cycle for senior housing. So that's an area where we're really bullish. Separately, the digitalization of data around the world, which AI has even just further accelerated. You're seeing the secular demand for data centers. So those are areas from a secular perspective we're really bullish on. The other piece is really focusing on strong supply fundamentals. So if I take it back to real estate 101 and think about supply and demand, there is a lot of uncertainty from the demand perspective as it relates to what's happening from the macroeconomic environment. But we do know what's happening from a supply perspective in real estate. And so here we're really focused on areas in real estate where there's just effectively no new supply. Areas like shopping centers really fits that bill, where you haven't seen new supply really of shopping centers in the last decade, call it. At the same time, you've seen demand grow just as a pure function of population growth. And so we're seeing really great fundamentals for shopping centers where a lot of the retailers and other tenants in shopping centers are trying to make sure they are located in the best brick and mortar spaces. Most of those spaces tend to be owned by REITs in terms of this really high quality shopping center retail portfolio. So we're really seeing some great fundamentals there. So bullish about shopping centers. And the other piece I would talk about, maybe just balancing the risks around inflation, as well as that uncertainty of growth that I mentioned from a macroeconomic perspective. So if I think about areas that you can capture inflation from shorter lease terms, and then also provide some kind of, I would say, resiliency for demand when it comes to a downturn or lower growth, an area like self-storage comes to mind. So those are the types of things that we're focused on here as we're thinking about building our portfolios today.
As you look ahead, are there certain dynamics or trends that you'll be closely watching with regard to their potential impact on REITs and the CRE investment outlook?
Yeah, one of the things that I think we're really focused on here is really just watching what's happening across the yield curve, how that is going to be impacting borrowing costs, how that could be impacting construction and development, for example. One of, I would say, the silver linings across the real estate industry, broadly speaking, is that we've really seen a pullback on new development and construction. And so you've seen kind of supply pull back pretty meaningfully, which is a great thing in terms of getting fundamentals back on track. And so if depending on what's happening from the perspective of borrowing costs, how that could impact construction is something that we're really closely watching in terms of our supply expectations. And the other piece also is, how is inflation trending? Like I mentioned, core PCE kind of has been trending the wrong way for the last several months. But as we think about the impact of inflation, especially on that lower end consumer, that's something that we've been watching and concerned about. And so I would say those are the types of things that we are watching from a macro perspective and the impact across real estate.
We've covered lots of ground and it's been a busy week. Any closing thoughts for our listeners today?
I think one of the things that we continue to harp on here is just that we are in a world of uncertainty. There is something new that comes up, it seems like almost every week. And we've been effectively in this world of uncertainty, which has effectively become the status quo of investing these days for I don't know how many years at this point, starting with COVID. So one of the things that we really focused on is making sure that we're really balanced and completely hyper aware of the underlying real estate fundamentals and doing so at the right price. And so we're trying to balance our risks from that perspective and recognizing the uncertainty that is in the marketplace. And that's the world in which we invest these days.
Excellent. Uma, thanks so much for sharing your time today.
Absolutely. Thank you so much for having me.
For our listeners, if you enjoyed this episode, be sure to check out the more than 500 earlier episodes of the REIT Report on your favorite podcast platform.